Hey guys, welcome to the Quantlab. The Quantlab में आपका स्वागत है. This video is all about volatility. We would be studying volatility using a very popular method which is powered by Hidden Markov Model, and essentially we'll try and understand how can we leverage volatility to make better decisions. Now, if you're an investor, you would probably want to make sure that you understand volatility and the regime to be able to do risk assessment, to do opportunity identification, to maybe even do portfolio optimization. You might be in as a trader and you would really want to do market timing, you want to hedge risk. And if you're just doing analysis, right, it's really important to be able to know what and where volatility trends are moving. So, in order to understand this, there's a good technique which I was studying, which is called Markov regime, and basically, this trading strategy leverages the concept of hidden Markov models. And what happens with hidden Markov models is, unlike traditional strategies and models, which assume constant Markov market behavior, HMMs kind of acknowledge the fact that the prices are dynamic and the phases are dynamic. There's a lot of distinct characteristics, like bull and bear trends. There's different high and low volatility period and stuff like that. So the way it works, this technique works this. We'll get into the code, but I'll just try to give a small explanation about it. Is it tries to identify the regime first, which could be trend, whether it's a bullish trend or bearish trend, volatility. Are we looking at a mean reversal? And what's happening and how it does using this is essentially using the data and modeling it and coming up with something called as transition probabilities, where it tries to understand that how long it is in a certain state and when it is looking to transition from a certain regime. Again, regime could be the thought of as periods of a certain trend sticking around. And these probabilities essentially provide valuable insights into potential market shifts and help anticipate changes. Now, these are really critical and important, specifically if you're a long-term trader or if you want to do swing trading. You can apply this technique in any time frame and is really, really beneficial. It can be, help you be a bit more adaptive. You could potentially get slightly higher returns if you have a good understanding of it. You can even use this to generate signals where, let's say, there's a trend which is running in a high volatility period. You might want to go short during that period, or if there's a low volatility period, you might want to go long in that. Now, with all things, there are downsides to this as well. It's prone to overfitting. It's kind of complex, that modeling and understanding it, but that's where this conversation comes in. What I'll try to do is come up and try and walk through in a very simple way. This is hardly few lines of code, so let's get started. All right. So what we have is just standard set of imports, and I'm just importing regular stuff. There's nothing specific here, minus StatsModel. Now, for people who are not familiar with StatsModel, I will just bring up StatsModel library and maybe talk about it. So StatsModel is, okay, let's open directly the page. StatsModel is a Python module which provides you pretty much an exhaustive list of Python functions and classes for a multitude of different statistical tools and methods. It has tests, it has techniques, it has trend analysis, it has models embedded in it, it has distributions, literally has everything, and is really, really in-depth library. You could do a tons of stuff with it, and it's really, really exhaustive. A great library for doing time series analysis as well. I have talked about it in some of my not future videos, previous videos, where I've touched upon this library as to what, why, and how important it is. All right, going back to the code. So then what we do is we just download the data. The data can be for any time period that you want to study, basically the data under observation. And for now, let's just take probably just a smaller data, 2023, and we'll probably end up with 2024. So just a year worth of data, probably good time period to study. And then I've downloaded it. did a little bit of small feature engineering. You could add more stuff in here, but I think this is more than enough. All I've done is taken the log returns and added that as a column. So you can see it here that the standard is with Yahoo Finance OHLC adjusted close and volume, and I have added returns on top of it. So now what I've done is I've just pulled and created a model under using the StatsModel libraries and APIs, and I have added the parameters around it. I don't want to get into the maths because that will get into talking about a lot of mean and reversions. But essentially, we've just built a model. This is a good starting point. You can play around with it and see how how many regimes you want to come up with, how do you want to see, etc., etc. In this, essentially, there's just two regimes: periods of high volatility and low volatility. But I'll try to show how it works out if I make changes. So I've done that model and essentially plotted it. So what we can basically see is, I'll just clean up and rerun it because I changed the time frame, is that within the past year, this was really crazy. This period was really fluctuating, and we have had periods of ups and downs throughout this. Now, if you go and increase this to probably 2020 and then run it forward again, what you'll see is you'll try and understand and see that the trend is different. While we just saw that within the last year, the volatility was really fluctuating high and low, but now you can see it's not so much showing up in this chart. Why? Because we have looked at a different time frame, and the concept of volatility or the concept of what is high and low can be perceived differently by the model over different time periods. So this is really critical to understand what you want to study and how do you want to go about it. Now, if I have to, give a one-liner statement, I can look at this and conclude that the volatility during COVID period was really high. There were periods of sustained high probability, high volatility, and that lasted probably somewhere around 2021 mid, which is where somewhere COVID downtrend started. And then there was again some sort of a third wave or something in this called time frame, and then you again saw that. So this is a different way of studying volatility, while changing it to a smaller time frame is giving me a very different kind of calculation. I can further reduce this and study it, but again, it might not make a lot of sense. So this is purely time dependent, and it's important to understand. I'll also try to show what this does. I think that, yeah, you see, so this is now giving a very weird and a different kind of signal. I personally don't know how to interpret it. uh, Given that it's a model and mathematics based, it will give you an answer, but it's best to stick with two. And that's pretty much how I try to study volatility. Now, using this, you can come up with different trading strategies, about which we'll talk about in some future videos. So if you have been following my series of decoding strategies, what I've been trying to do is take up a strategy which is pair trading, start from Excel, converted it into Python. Now I'm trying to add more conversations to it, how to study volatility essentially, and slowly and eventually we'll plug all of them together, and maybe we'll have a very long conversation about how everything neatly ties together, and we have a strategy around pair coding with trading, which probably works and is profitable. All right, with that, this is Akash signing off. Thank you for listening into Quantlab. Bye bye.